Okay, guys, it's Jojo here, and I'm going to be your host and for today's class. So, yeah, basically, what we're going to be talking about today is just the basics of Forex. What is Forex? I don't want us to dwell so much on it. I don't want us to waste too much time on it. It's just going to be a quick one. Then after that, we go to candlesticks anatomy, and from there we'll go to market structure. So yeah, since that's out of the way, let me start with what is Forex. So what is Forex? Forex simply stands for foreign exchange. Forex stands for foreign exchange. What is Forex? What is Forex? Forex stands for foreign exchange. It's a global, decentralized market where we exchange currencies, ideally for money. It's a global, decentralized market where we exchange currencies, ideally for profit. So, unlike other markets, like we have the stocks market, commodity market, that that has a central party, Forex is like it's different. It's not like those ones. It's a decentralized, market where, both the banks, the brokers, everybody come together through via an electronic network. So that's like what Forex entails. That's what Forex is. So yeah, but the Forex market is one of the biggest markets in the whole world, with a daily transaction reaching nearly a staggering number of about, $6.6 trillion daily. Even the entire stock market and commodity market cannot even like come close to how much is being traded in the forex market in a single day. Like that's how crazy, how big the forex market. And what makes the forex market very attractive is its volatility. So its volatility is what makes it very attractive. Its volatility. So yeah, yeah, and then I feel like even the entire US stock market alone is about $0.25 trillion. Like the US stock market, $0.25 trillion daily volume. But the forex market is, $6.6 trillion. Sometimes it gets to seven, while sometimes it even gets to $10 trillion transactions a day. So that's just how big the forex market is. And yeah, let me give you a definition, a simple term about forex trading itself. So forex trading is simply the act of buying money and waiting for a shift in an exchange rate and then selling it back to the market. So you're buying money and you're waiting for a shift in an exchange rate and you're selling it back to the market. That's what forex is. You understand? That's what forex is. The act of buying money, selling to the market and waiting for a shift in an exchange rate, selling it back. So, there are various amount of strategy people use on for FX. Some person uses these expert advisors. Some person use, technical analysis. There are different part style people use in trading forex. You know, some people just don't have string, they use bots, indicators, and also yeah, there are various with technical analysis. But I feel like that's the best. Learning with technical analysis, then you're good to go. So yeah, so now we're done with forex. We're going to talk about a currency pair. So what is a currency? What's a currency pair? What's a currency pair? So a currency pair is simply the quotation of the relative value. A currency pair is simply the quotation of a relative value of a currency unit against the unit of another currency. So what they're just trying to say in short form is that no currency on its own has a standalone value. No currency on its own for a currency to have a value, you need to quote it with another currency. You cannot say like euro, for example, or GBP is going at this price. So you need to quote it at another currency to give you that price. So let's just say, for example, um, we have euro USD, and euro USD is trading for maybe 1.3035, 1.3035. What it means that 1 euro will cost you 1.3035. That's what it means. 1 euros will cost you 1.3035. If it's euro JPY, and let's say JPY is trading for 185.366, it means that 1 euro will cost you to get 1 euro, it will cost you 185.366 Japanese yen. That's what it costs you to purchase 1 euro. So that's why how currency pairs. So if for it to have a value, you need to quote it with another currency. So you cannot just say euro alone. You need euro USD, euro US dollar, or euro Japanese yen, euro JPY, or euro GBP, euro and Great Britain pounds. So that's it about currency pair. And there are 8 major currency in the world. There are 8 major currencies in the world. We have our US dollar. We have US dollar. We have Japanese yen, JPY. We have Great Britain pound, Great British pounds, GBP. We have AUD, that's Australian dollar. We have Canadian dollar card. We have CHF, Swiss franc. We have, I'm going to write them out. We have NZD, New Zealand dollar, New Zealand. So all these are the major currencies. One, two, three, four, five, six, seven. I think one is missing. Euros. You have euro. So these are the major currency we have. These are the major currencies we have. This is Swiss franc. Swiss franc. Swiss franc for CHF. Canadian dollar is CAD card. Australian dollar AUD. Great British pounds, GBP, Japanese yen, euro, US dollar, New Zealand dollar. So these are the major currencies in the world. These are the major currencies in the world. So yeah, when a currency pair is bullish, now let's just say let me search for Euro USD, Euro USD, Forex. When a currency pair is bullish, when a currency pair is bullish, the base currency, they are like in a currency pair, we have our base and we have our quote currency. We have our base, our quote. So if you have something like um Euro USD now for an example, maybe Euro USD. The base currency here is Euro. This is the base currency. Why this is the quote currency? So this is what you're quoting it with. That's why it's Euro USD. There is Euro JPY. Euro JPY now, this is your base, why this is your quote? You're quoting it. So how they get the prices? This alone now can have a value as it's quoted like this. But if it's not quoted, it can't have a standalone value. Euro cannot have a standalone value on its own. So you need to quote it. You understand? So now Like this now, what it means that for if it's like we're on Euro USD now, it means to purchase 1 euro, what is the current market price? 1.15979, 1.15979. So it means that to purchase 1 euro, it will cost you $1.1579 to purchase 1 euro. That's what this thing means. That's how currency pair work. You understand? So now when a currency pair is bullish, the base currency shows that the base currency is pumping, like has strength. And then there's this thing we used to note which currency has more strength. The currency strength meter. So you can search it on your browser, currency strength meter. On that this thing, it will show you which one has more strength. So now for it to this Euro USD, right? And let's say we go to the 4 hour time frame on Euro USD. On the 4 hour time frame, you can see that Euro USD, okay, I think daily will be better to get the better view. Now you can see Euro USD is bullish on the daily time frame. It's bullish. Yes, and so now but currently what's happening now is bearish move on a lower time frame, maybe 4 hour. You can see it's selling, but it's not the overall trend is bullish. So now that Euro USD is selling, what they are saying is when a currency pair is bullish, the base currency is pumping, while the cross currency is dumping. So let's say in Euro USD now, if Euro USD is pumping, it means that if you check well, you will notice that dollar is selling. That's why Euro USD is pumping. Dollar is selling. And how to know what's happening to dollar? There's this thing called the XY. The XY. The XY shows you the XY. Okay. The XY now shows you what's going on. As you can see now, dollar is in an uptrend here. But if you go to Euro USD, EU, if you go to Euro USD, you see that Euro USD is selling. It's selling, but dollar is buying. So that's just how it is. So when the currency pair is the base currency, when it's bullish, when the base currency is bullish, if you go and check the one quoting it, you see that it's bearish. Check their basket, like the Japanese yen now, we call it JPY basket. You go and check it there, you see what's happening there. So that's that about currency pairs. So um I'm going to talk about um a pip. What's a pip? We're going to move to pips. Now we are done with currency pair, we're done with basics, the definition of Forex. So we're going to talk about pips. I don't know, I don't know, a lot of people have been in signal groups now. You see um gold has gone 100 pips, it has gone 500 pips, it has gone, there's how they do all those things, there's how they calculate it actually. There are ways to calculate your pips. You can use your positions this thing to calculate your pips. Let's just say, for example, um, something like this now. You see that this is your pip here. This is 25.6 pips. That's what this thing tells you. Why this one now, this long one is showing 166 pip. And how to be certain that, okay, this is actually true. You can use your ruler to mark from here, mark to the highest point. You see that it's the same thing. 166. Are you seeing? 166 pips. So 166.8, 166 point. So this is how like pips works. It's easy, you know, for in your chart. Like it's easy to just know what your pip is in your chart. So you can just be there. Somebody will say, okay, call out. Somebody will call out a trade and be like, buy gold now. And if you buy it, they say gold have moved up 100 pips, 200 pips. That's how you know. You can use your ruler to know, you know. And aside from that, let's just say, for example, now this let me give you the definition of what a pip means. A pip is simply means the percentage in points. It is a unit for measuring the change in value between two currencies. In a currency pair that has like five decimal places, like just say Euro USD now, there's after this point we have one, two, three, four, five decimal places. So the fifth this thing, like see this one 1.15979. The last decimal point, that's your pip. That's how you start counting. So if this thing increased to 1.59, 1.159780, it has increased one pip. If it goes to 1.15981, two pips added. That's if it's buying. That's when to be increasing. It's increasing, it's increasing. So you can be tracking it from here also. So that's just what a pip means. A pip. So that's that about PIP. So I'm going to stop here. So maybe in the next class, we're just going to go straight to lot, leverage, and margin. Then after that, we'll go to candlesticks. I don't want us to dwell so much on all these things. Then after candlesticks, we'll go to um, um, market structure. So basic market structure. So yeah, that will be all for the class. Thank you for watching. Please do well to subscribe and turn on post notification. Thank you.